All right, so guys, welcome to another video. And yeah, so as you guys can see, um I'm at home and the time right now is October the 24th. And finally, for some reason, Euro USD decided to give a buy opportunity finally. Okay, after like 2 weeks of being in a proper bearish market, all right. Euro USD decided to give a buy, and I'm going to be breaking down this particular buy opportunity that was presented today on Euro USD. More so from a liquidity perspective this time. All right. So it's going to be a very, very interesting trade breakdown, just like with every of my trade breakdowns. And just pay attention to, the key points I'm going to be touching on. And of course, you're not going to have any problem with understanding these concepts because, again, these concepts are very, very simple concepts. All right. The concept of market structure, the concept of, in this case, I'll be using liquidity and also fair value gaps and how you can utilize that with internal structure. It's going to be a very, very interesting video. All you have to do is, of course, bring out your pen and pads, man. Profit gang, y'all know what it is. Hey, let's jump into the video right now. All right. So I'm going to be sharing my screen with you. This is Euro USD. I strongly want to believe everybody can see my screen. I'm going to be taking out this video here just so I won't be distracted to the viewers. Okay. So I'm going to be taking out my video here. Maybe I'll pull this up to this area here. I don't want to be distracting to anybody. All right. Now, this is what we're going to be talking about in today's video, okay? We're going to be talking about not just market structure from a macro perspective, but we're going to be talking about market structure from an internal perspective, okay? I believe everybody can already see the area of market structure I'm going to be talking about in this particular video. Of course, you can see based on the markup, you can see levels of liquidity, and of course, you can see your internal market structure, and of course, your internal order blocks as well. All right. Now, before I'm going to be jumping into the video, okay, just give me 1 second. All right, so let me have my H2O. A lot of things are about to be said. All right. All right, so looking at price action, okay, for the past, I believe 3 to 4 weeks, okay? This is on the weekly time frame. And of course, on the weekly time frame here, you can see we have a couple of bearish candles, all right? So all of this has been price action from the past couple of weeks. I'm talking about, the last 4 weeks, okay? Because what we can see here clearly is 4 bearish candles, all right? Now, again, just like I like to say, the market is both bullish and bearish at the same time. I'm saying that from a place of market structure, okay? If you look at the market from a certain perspective and you have a bullish bias on the market, you can definitely find areas where you can look to buy the market from. All right. And in this case, looking at the market from a weekly perspective on the weekly time frame, the weekly order block we can see here is this. Right. I don't want to go into the stress of marking a weekly structure. I believe we can all see the weekly structure at this point. I mean, if you've been watching my videos, then of course, we use the part 2 for structure. This is a low. This is a high. This is a low. And of course, we can see the market breaking structure to the upside. Now, according to the law of market structure, okay, whenever we have a break of structure to the upside on any given time frame based on the fractal nature of the market, but that's a whole, that's another topic on its own, okay, the fractal nature of the market. Okay, but basically, according to the law of market structure, whenever there's been a break of structure to any direction in the market, okay, an order block is formed. All right. Now, if this order block fails to be mitigated, then we have liquidity formed in the market. Okay, so liquidity basically is as a result of structural imbalance in the market. And, when I say something like that, I've now introduced another terminology that is known by a lot of people, which is imbalance. But at the end of the day, right, liquidity is formed by a structural imbalance in the market. Okay, now some people would argue that an imbalance and a fair value gap are different, but I'll tell you, technically they are the same. Okay, but in terms of the formation of, a fair value gap, depending on the formation of an imbalance, we can now separate them to say, okay, based on this and this and this characteristic, we can call this a fair value gap. And then based on this and this and this characteristic, we can call this an imbalance, just to differentiate the two. However, technically, they serve the same purpose, all right? A fair value gap is also an imbalance, just like an imbalance is also a fair value gap, all right? But basically, according to the law of market structure, whenever you have a trend and you've had a break of structure to the upside, okay, naturally, you should have an order block position, all right? In a case whereby that particular order block fails to become mitigated, then you're going to have something like this. You have your order block. Your order block fails to be mitigated. What is now created underneath this structural level here is liquidity. Now, why is there liquidity underneath this level? All right. It's simply because according to the rule or according to the law that governs market structure, whenever a particular higher low level causes there to be a break of structure, to the upside, then of course this is a valid order block as well, because the market can indeed, just pull back to this order block here and then push to the upside. All right. The market can, do something like this. Now, if this happens, you see the market is failing to come back to this order block. All right. Now, since this is a possibility, there are a lot of people that are willing to put their money behind that possibility. All right. There are a lot of people who we will now tempt to be early buyers when eventually the market take out that liquidity. All right. But there are people who are willing to risk their money on this position here. And typically the stop losses are going to be below the order block right there. All right. Now, immediately anybody places a trade along this, order block here, which is very, very much valid according to the law of market structure, okay, is a possibility that the market can react from that order block and continue to the upside. All right. So if people are willing to put their money behind that particular trade idea, then they're basically putting liquidity along this particular area of the market. And of course, their stop losses are going to be below the order block there. So these guys, okay, that are putting their money into the market here, all of their stop losses is now the liquidity, okay, that's going to be grabbed if the market decides to use this particular order block here, which caused this break of structure here. All right. So this is basically how liquidity is formed. All right. Now, if you look at what happened here, especially when you understand internal and external market structure. Now, if we say this is the external market structure on the weekly time frame, let's put that in black. Now, if the leg of price we are going to be examining is now this leg here, all the way to that high there, then what is the internal structure of that leg? Okay, because typically you're going to find your liquidity within the internal structure. Okay, you're basically going to find the liquidity within the internal structure. Now, on the weekly time frame, what do we have as the internal structure of that leg? There we have a low, we have this as a high, we have this as a low. And then, of course, you can see how the market is taking our structure to the upside. So internally, there was a break of structure here. Okay. Internally, there's a break of structure here, which makes this area here an order block. Okay. It makes this area here an order block on the weekly time frame. And just like I explained, when you have multiple order blocks like this, there are people who are willing to risk their money on the first order block. And also there are people who are willing to risk their money on the second order block here. All right. So just like I explained here, now you see the market came all the way below the first order block, and it seems to now be reacting from the second order block. And of course, you can see a sharp reaction away from that order block. All right. So the first one here, we can now say has been liquidated. All right. So let me turn the internal structure here to red. So I guess this gives you a better view of what I'm talking about. All right. I guess this gives you a better view of what I'm talking about. It's a very simple concept, okay? But now I'm kind of like executing the concept on a higher time frame. As I now go lower to a lower time frame, maybe it's going to get more technical to the eye. All right. But when you train yourself to understand market structure, especially internal and external market structure, macro market structure, okay, and for lack of better words, micro market structure. All right, higher time frame market structure, lower time frame market structure. Okay, that's what I mean by internal and external structure. Now, from the weekly going on to the daily time frame, we can start to see things a little bit clearer. All right, so already, I'm going to remove this. You can see the internal structure here on the daily time frame. Now, based on the internal structure on the daily time frame, you now know where we can have our daily order blocks. Okay, you now know where we can have our daily order blocks. So just looking at the internal structure on the daily time frame now, you can see again, we have this order block here where it's definitely a valid order block on the daily time frame. And of course, you can see there was a reaction, upon mitigation of the order block initially. Okay, you can see the market reacted from the order block, and there was, maybe a trade opportunity in there, but at the end of the day, there was no confirmation that the market has returned, to a bullish market. All right, so from here you can see it was a continuation of the downtrend, and of course the market has been in a very huge, massive downtrend for about 4 weeks. All right, so of course you can expect there to be a reaction once the market reaches that order block, but there's no guarantee that that particular order block is going to hold, regardless of the fact that is a very, very valid order block. Okay, regardless of the fact that technically is a valid order block, but again, don't forget we are trading, a marketplace that is more so probabilistic. Nothing is actually guaranteed in the marketplace. All right, so there was a reaction from that order block there, but of course the market also knew, okay, at the end of the day, nobody really knows exactly what the market is going to do. But I believe there are people who push the market to particular price levels. There are people who manipulate the market and things of that nature. But truly, truly, I don't believe there's anybody that's out there that knows exactly what the market is going to do. But based on certain concepts that we have now, developed or that we have now learned, we can now predict the markets in a semi correct manner. Okay, because we can only be 50% correct at the end of the day. All right, so the market grabs all of that as liquidity into a daily order block. Now, this is on the daily time frame. That particular daily order block is coming from this internal structure level. All right, you see there was a very, very nice reversal around there. Very, very nice reversal around this area here. You can see how a bearish market consolidated for a while and then turned into a bullish market via a change of character. Okay, simple bearish reversal pattern here. Okay, this is a low, this is a high, that's a low. Okay, at this point the market is still in a consolidation. Okay, this, and then there was a break of structure to the upside. It was one level of structure and 2 levels of structure. All right, so here there was a break of structure here, and of course there was a change of character here. All right, now again, this is the difference between break of structure and change of character. Now they are both break of structures technically, okay, but because this one is the first break of structure to the upside while the market was currently in a downtrend, that's why this one is the change of character. Okay, that's why this one is the change of character, and this one is the break of structure. But technically they are both break of structure to the upside. All right, so after that break of structure, you can see the market pulls back, mitigates this order block here based on this break of structure and of course change of character here. So you can see the market coming back to the order block there, mitigating the first order block there. Okay, so let's say this is a daily demand level, and let's lock this in, go to the settings, go to style, extend to the right. No. Okay, I want you to see the market mitigating the first order block there. All right, if we are to mark out the structural levels here, we can see that is a low. This is a high. That's a low right there. And of course, there was another break of structure to the upside here, and then the market took off. Now, the market never came back to mitigate that order block. All right. So based on that level of internal structure, this area became an order block. Now, it's not a coincidence that we had this order block right on top of this one with this one unmitigated. That liquidity was so clear. That's why you can see marked out there liquidity. Now, of course, even before we got to that level, this was also a previous daily demand level. Okay, that was also a previous daily demand level. And then, of course, this was another daily demand level. Okay. Now you can see the reactions from those demand levels as at the time the market got to those demand levels. Okay, but the market was still very much bearish at the time. Okay. Now, when it comes to liquidity entry, you want to wait until the market sweeps the liquidity into a demand level. Then you want to look for lower time frame confirmations around this area here, which I'm going to cover in a few. Okay. Again, you want to wait for the market to sweep liquidity into a demand level. Then you want to see lower time frame confirmations in real time. Okay. You want to see lower time frame confirmations in real time. Okay. Now, assuming the market has already invalidated this level here. Okay. This level here has already been invalidated. So we can now just remove this just to make the chart a little bit clearer. All right. This level here has also been invalidated, but that right there is the last point of liquidity. Okay, so we're not going to remove that here because we want to see the market sweep that liquidity into the demand level. Now, basically, you also want to refine your demand levels down to maybe the 8-hour time frame, 4-hour time frame, and things of that nature. But let's see on the 8-hour time frame. Eight-hour time frame. Okay, so on the 8-hour time frame, I mean, typically this should be your order block, let's say from the week of this all the way down there. But sometimes you want to take the engulfing. I believe I marked this out based on the engulfing. Okay, I believe I marked this out based on the engulfing. Now, the candle that I'm talking about is, you can use the 8 hours time frame, you can use the 10 hours time frame, you can use multiple different time frames. Okay, I'm talking about this low here, all the way to this candle's high. Okay, that's the area of my order block. Now, typically you want to take this candle here, maybe the high of this candle to the low there, but sometimes you can take the engulfing candle, especially when you're not setting you're doing multi-time frame analysis. You want to borrow this idea from quote unquote retail traders and implement that in picking your order block here. All right, so you don't have to be too perfect when you're trying to draw your order blocks. All right. So that's our order block. You can see how the markets, excuse me, swept liquidity into the order block. All right, so excuse me, guys. I was having a moment there, so I had to, take a brief break just to get myself sorted out. Okay. So as I was saying, I know my charts are looking a little bit messy right now, but try and keep up with the analysis. All right. So let's go to the 10-hour time frame. Okay. Let's go where we can see an actual order block. Now, in real time, you also want to try and manipulate, price like this. In real time, you want to try and manipulate price like this. All right, exactly. So you can see on the 10-hour time frame, now we have our engulfing candle on the 10-hour time frame. So this is on the daily time frame. This is on the 10-hour time frame. Okay, let me make the yeah. I want to make this very blue so you can see inside of the daily time frame, we have the 10-hour time frame. Okay, so what I'm doing here is basically I'm refining daily order block into a smaller area whereby you can actually take a trade from. Now, the liquidity becomes even clearer on the 10-hour time frame. Of course, you can see the liquidity right there. Okay, if we could just go back to the daily time frame, click on this, go to settings, change the visibility, 24. All right. So if we go back to the 10-hour time frame, you can see that liquidity becomes even more visible. Now, I said you want to wait for the market to sweep liquidity. Okay, that's the first thing. The market sweeps liquidity into the demand level, sweep of liquidity into demand level, and then you want to see lower time frame confirmations. That's going to tell you that the market has now shifted back to the upside. Now, just to go in there to see the lower time frame confirmations on the 15-minute time frame, let's use the 1 hour time frame here. Okay, 1 hour time frame. Now, this is what we mean by lower time frame confirmation. Of course, here you can see that the market was in a downtrend. And then after a while, if I can remove this now, simple reversal pattern. That was a high. That's a low. This is a high. This here is a low. The market pulled back into a valid supply level on the 15-minute time frame or on the 1 hour time frame. Okay, failed to go lower. Then we had a break of structure to the upside there. All right, which gave us this as an order block. All right, so this was the entry. That was the entry. So right there was the entry. 10 pip stop loss here. Okay, if you're keeping it real, target all the way up there for a 1 to 6 risk to reward. All right, but that's not even the entry I want to show you guys. Okay, the entry I want to show you guys is on the re-entry. Okay, on the re-entry. Now, of course, you can see break of structure to the upside yet again leaves this area here as an order block. All right. Now, a lot of the times you might not want to take a trade like this because the order block looks very huge. But at the end of the day, since you understand that the market is still going to just push to the upside, even after mitigating the order block, and of course, you can definitely take, of course, you can see the area target entry. So that was re-entry right there. So that's another buy trade. Okay. With the stop loss now underneath here. This one at the moment is already going for something like a 1 to 2.5. I mean, it's still going to go higher considering the fact that, we have all of these supply areas here to reach. Okay. Maybe we can have a deep retracement such as this. Of course, we have liquidity, okay, above this area here. We have liquidity above this area here. Internal market liquidity that, of course, the market can be reaching for. All right. Again, liquidity is created when a particular order block fails to be mitigated. All right. So if you see there was a downtrend here, there was a break of structure to the downside here. And that particular order block there failed to be mitigated. So that created this liquidity here. So now that the market is in an uptrend, these liquidity areas here are targets where the market can definitely look to reach. Okay. Now, of course, if you want to follow this trend currently, you can now go to lower time frame and use internal market structure on lower time frame. 15-minute time frame is not a bad time frame to use. This area just broke to the upside here. So an order block such as this on the 15-minute time frame is not a bad area to be looking for buy opportunities. Okay, buy opportunities. And of course, this area here as well is another area where the market can pull back to. And then we can see buy opportunities from these areas here. So, I mean, clearly you can see a gap there, a gap which is, again, an imbalance, okay, in the market. All right. So these areas are other areas where the market can pull back to and present other buy opportunities. But following the market right now on the current uptrend that it is, these are not sad trades to look out for. Okay. Of course, internally, you can see we are having break of structures to the upside. If we take out these supply levels here, which again, on the 15-minute time frame, these are liquidity areas. So here, this is an obvious target. This area also is an area of liquidity. But we don't want to see this on the daily time frame. We don't want to see this on the hourly time frames. This is internal range liquidity, just simply coming from the internal structure of the market. That's basically what it means, okay? So sometimes don't pay too much attention to the terminologies, man. Just understand that there's internal structure, there's external structure, okay? Internal range liquidity is liquidity coming from the internal structure of the market. Of course, when I go back to the 4-hour time frame, that liquidity basically disappears. You can't see that liquidity, all right, on the 4-hour time frame. What you see on the 4-hour time frame is a 4-hour order block, right? Now, for the reason why some people would see a 4-hour order block here, and of course, look at this one here is left unmitigated, all right? So this is exactly what I was talking about. There's one order block here on the 4-hour time frame is left unmitigated. So this is a 4-hour supply. This also on the 4-hour time frame is a 4-hour supply. Okay, but why would I pay more attention to one order block and, look at one order block like the market is going to come above that order block? Is because of the liquidity line above the order block. Okay. Sorry. So there's clearly liquidity lying above this order block here. And I said, once people are willing to trade from a particular order block, they are already putting in their money, into that area of the market. So they are imputing liquidity into the market. Liquidity is basically money at the end of the day. Okay. So people are willing to trade from this order block. They are imputing liquidity into that order block. Okay. And at the end of the day, we're going to see if all of that liquidity is going to be swept. If basically all of the people, putting their money along this area of the market for a sell position, we're going to watch if they are all going to be liquidated out of their positions before other people now buy and sell from a higher price. Okay, because at the end of the day, selling from a higher price is technically better than selling from a relatively lower price. Okay, let's just keep it real. Okay, if we're looking at buy low, sell high, where is the higher point? Whereby if we sell from a higher point, we can look to have the most risk to reward ratio. Okay, is this area here. All right. So technically, just looking at it, like, okay, I want to sell from a higher point as opposed to selling from a lower point. So everybody that's selling from a lower point, they're probably going to be liquidated out of the market. And that's the idea of liquidity. All right. Well, now again, going to the 1 hour time frame, you can see, let's go to the 15-minute time frame rather. On the 15-minute time frame, these are clear liquidity levels. Okay. Now we can use these liquidity levels as targets for our buy trades. Okay. You can use liquidity levels for your entries. You can also use liquidity levels as targets. Liquidity on the opposite side of the market now, you can use that as targets for your trades. Okay, for your buy trades, you can say, okay, since the market is going to come and sweep this liquidity here, I can hold my trade until the market sweeps that liquidity. Or when the market sweeps the liquidity here, I might be taking partials from the market and things of that nature. Okay, so yeah, that's the buy trade. I just wanted to give you guys a little bit of a trade breakdown here. Hopefully this is going to answer some questions that somebody has about liquidity. This is going to, again, answer some questions that somebody has about internal market structure, internal range liquidity, and things of that nature, okay? Again, if you're not subscribed to the channel, okay? If you are not subscribed to the channel, hit the like button right now. Hit the like button right now and subscribe to the channel, okay? If you're not subscribed to the channel, hit the like button right now, subscribe to the channel, so you can force the YouTube algorithm, okay, to push this video out to more traders. A lot more people need to watch these videos. A lot more people need to, get educated. And I believe I'm adding to, the number of countless educators that's out there that's providing value in the trading community. All right. So without any further ado, man, I'll see you guys in the next video, man. Gang, gang.